everyone. Welcome to another session of Tips and Info from SW Lim & Co. One of the common scenarios that small and medium businesses face is the puzzling situation of achieving profit but struggling with cash flow. Why do this happen and how to overcome it? Come on, let's study this together. So, you happily announce that your business is making profit. Yay! That is indeed a very good news. It means you are clearly meeting the objective of your business. Of course, you are costing your product right as your earnings clearly exceeds your costs. All your earnings have exceeded your expenses for the reported period, be it monthly, quarterly, or annually. I'm happy for you. You are off to a good start. But the story did not end here. There is more to consider. That's because profit does not guarantee cash, which I'm going to demonstrate later. Profit fluctuates. A profit is not sustainable without a good cash flow. Having a profit without healthy cash flow is like having a room without windows. You know what I mean? As we always say, cash is king. It is the oxygen to your business. Before we explore further to our case study, we need to have some basic accounting lesson here. Don't worry, I'll try my best to keep this short and simple. In accounting, we apply accruals concept in recognizing revenue and expenses. There is three main accrual concept that is key in order for you to understand accounting profit. First, revenue is recognized when earned, not when received. What this means, we will record a revenue at the point the revenue fully belongs to you, not the point when your customer settle the payment. Example, you make a sale and invoice it in September, allowing your customer to pay 30 days later. We record your sale at the point of invoicing, which is September, regardless when your customer is paying. Second, expenses is recognized when incurred, not when paid. We will recognize your expense at the point when you are liable for the expense, not the point a payment is made. A good example would be rental. We will record September rental in September, even though you choose to pay it 3 months later. And the third important one is the matching concept, which says expenses are matched with the related period of generating the revenue. Example of this will be the cost of your product for sale. Let's say you purchased 3 units of power bank in September and you sold only 1 unit in December. The cost of the 1 unit of power bank are recorded as expense in December together with the sale. The remaining of the 2 units will be sitting as your stock or inventory until you sell them. There are many others application to accrual accounting, such as depreciation, accrued interest, and many more. This is too in-depth for me to cover in this short video. Drop me a note if you want me to cover it in upcoming sessions. Oh, also, please note that I am only explaining the umbrella concept of the accrual accounting, as different treatment may apply in reality due to different local accounting standards and local tax laws. Now that we understand accruals, we can continue with our simple example below to understand how profit is different from cash. Let's assume you bought 300 units of inventory in September and paid them 3,000 ringgit in full at the point of purchase. Hence, the cost is 10 ringgit per unit. Your monthly store rental is 1,000 ringgit a month. You decided to pay 3 months rental in September to reduce the hassle of administrative work. Then, you immediately sold 100 units in October, offering your customer 30 days credit terms. Right, your selling price is at 50 ringgit per unit. In November, you sold the remaining 200 units for 10,000 ringgit with the same 30 days term. Since you are already out of stock, you purchase another 300 units for the same 3,000 ringgit. Simple and clear? Now, using the accrual concepts that we have just learned, how do we record these transactions? In September, we paid 3,000 ringgit for stock and 3,000 ringgit for rental. What is our sale, cost of goods sold, and rental that we recognize in the book? Right, you make zero sale and you recognize none of the costs due to matching concept. As for rental, only September rental is incurred, hence we recognize only September rental. As such, we make a 1,000 ringgit loss in September. In October, we make 5,000 ringgit sale, but you have not received the payment. How much are we recording in our books? That's right. We recognize the full amount you have sold and the cost of the 100 units for 1,000 ringgit at the same time. Rental remains at 1,000 ringgit. Yes, we make a 3,000 ringgit profit. Finally, November, we make another 10,000 ringgit sale and purchase 3,000 ringgit stock. Why don't you tell me how much is recorded in the book? That's right. We record 10,000 ringgit sales, 2,000 ringgit for the cost of goods, and rental of 1,000 ringgit. Oh wow! Another 7,000 ringgit profit. Let's see. We make 9,000 ringgit net profit in 3 months from the 15,000 ringgit sale. That's a high 60% net profit margin. Using the same example, let's look at our cash situation. How much have we collected and paid in September? That's right, we paid 3,000 ringgit for the goods and 3,000 ringgit for the rental. That's a cash outflow of 6,000 ringgit. How about October? We make a sale, didn't we? Oops, there is no cash collected as there are 30 days credit terms. Lastly, November. We collect 5,000 ringgit from October sale and paid another 3,000 ringgit to restock. At least now, we have a positive cash inflow of 2,000 ringgit. How about the 3 months cash position? Oh, we are having a 4,000 ringgit cash shortfall despite our high 9,000 ringgit profit. This is a simpler replication of what happens in real life that is made even more complicated by huge volumes of transactions and activity. Now, let's analyze what happened. First is the inventory holdings. As we can see, stock holding frozen up your cash flow. Not forgetting, some businesses also incur additional charges in storing them. As provided in the example, you pay for the inventory upon purchase while collecting 30 days after sale. That is 60 days for the inventory to be converted to cash provided you sell them all. Second, we can't accurately predict the pattern of sales. Slower sales will cause slow stock turnover. Third, As purposely highlighted in the example, sometimes we pay our vendors a little too fast. Transferring payments every day definitely is time consuming, and as a result, we often pay in advance. Well, now we recognize the cost. Can we find the solutions? Let's see. For inventory, we need to balance our need for higher profit versus the need of having positive cash flow. It makes sense to offer more attractive lower price to customers for advance ordering and bulk purchase as they reduce holding days. Important. Plan twice as careful when ordering high MOQ product. MOQ as in minimum order quantity. Next, work with your accounting team to help with some analysis. Many businesses are selling too much variety of products so that they earn much higher sales. This also means the more stock you need to hold, especially if each comes with their own MOQ. Try and evaluate how many percentage of your products are contributing to, let's say, 80% of your sales. You might be surprised. Why not focus on those? Sales or cash? You tell me. Third, if your products have limited shelf life, aging analysis and product planning is essential. Talk to your accountants on the relevant reports that can assist you. Next, customer management. As mentioned earlier, promotional package promote sales and expedite stock turnover, combining both fast and slow-moving stock in the package to kill two birds in one stone. Offer credit terms wisely, as not all customers pay promptly. Make use of your accounting software and impose a reasonable credit limit. Some businesses insist no credit terms provided for purchases below a certain quantity or amount. This would definitely reduce collection days and the risk involved. Again, make use of useful reports to help you analyze and strategize. Last but not least, vendor management. It is always worth the effort to negotiate for credit terms. Consider using less vendors by having a selection of preferred vendors to increase your bargaining power. Again, utilize the capability of your accounting software to create payment due reports to avoid paying too early without creating too much admin work. Pay on a fixed cycle after generating payment reports will help achieve this. Again, work with your accountants on the ideal payment procedures for your business. Many businesses lost cash from double payments and not even realizing it. Finally, if cash is your continuous struggle, it's time for cash flow planning. It doesn't need to be a complicated process, but it allows you to predict the situation and find solution earlier. This can be easily done through a simple Excel spreadsheet. I have to repeat, cash is king. Profit is not sustainable without cash rolling. Alright, I hope you benefited from this session. Please like and share if you enjoyed the video. Thank you.